Right. Welcome back to Principles of Accounting 1. It's already the middle of November, if you can believe that or not. The time is just flying by. We're already in the middle of November, and we're making great progress. So I'm super happy with your progress that you're making in the class so far. It definitely does not go unnoticed. So I just want to say thank you for that. Um, I want to show you where we are and where we're heading first, and then we'll jump into today's conversation on partnership accounting, which is a very short, simple, sweet type of conversation that we'll have today on partnership accounting. After partnership accounting, we'll jump into accounting for corporations, a little bit more complex because we're going to be talking about stocks, how stocks are issued, stocks and bonds, those type of things. Um, the following week brings us into Thanksgiving week. We're going to talk about long-term liabilities. Pretty straightforward there. We're talking about basically like bank loans, how interest is calculated, that kind of thing. And then we'll jump into our last week, which is week 15. We're going to be talking about investments that companies make, as well as which is the fourth financial statement called the statement of cash flows. And then that will bring us da 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 to the final exam. Um, so it goes by really fast from this point forward, is what I'm trying to say. So my recommendation to you is to think about trying to work a little bit ahead, so that way um, it lines you up for a smooth uh, final few weeks. Yeah. I don't want you to feel overwhelmed by having this course plus your other classes, all, at the end, you got the exams, you got projects, you got whatevers. I don't want you to feel overwhelmed. So I recommend that you try to do a little bit of work ahead because that'll definitely help you looking forward. Yeah. So let's take a quick look into this week. We, of course, have our respective quiz, but we also have the second part of a LinkedIn Learning Certificate for financial accounting. So some of you have already done this. Thank you so much for that. I think it was also accidentally in the prior week. So, but I appreciate you doing it. If you've done it already, thank you. Obviously this is a required certificate. It's called Financial Accounting Part 2. It's due this Sunday night. It's kind of more or less of a continuation of what you learned in the prior financial accounting certificate, the part one, which I think was a couple of weeks ago. I really like this one in particular, and the reason why I like financial accounting part two is that it covers exactly what we're talking about, not just this week, but also for the rest of the course. And so you'll find that when you take this certificate, um, it's certainly going to help you, especially as we get closer to the final exam. So if you haven't done it already, strongly encourage you to get this one done as soon as you can because it's really going to be super, super helpful for you for the rest of the course. Yep. So engage and explore. Week 12, Financial Accounting Part 2. Great certificate. Strongly recommend it. I mean, obviously, because it's required, but strongly recommend it because it's really good content. So, two action items for this Sunday. The LinkedIn Learning Certificate is one. The second one is the chapter assignment here. So, those are your two action items for this week. So, without further ado, let's jump into tonight's conversation on accounting for partnerships, which is a really fun topic. At least I think it's a fun topic. The reason why I like partnership accounting is when I was in business, when I had a small, I think I told you guys, I had a small wholesale, retail, and distribution company, and this company, I took it from zero to $3.2 million in sales over the course of I don't know, about 7 years or so, and it took a lot of hard work. Yeah, I was out there selling, sampling product, talking to a lot of people, trying to build connections, building up interest in these products that I was selling. It's really hard, really, really hard. And what I found was people are really interested in the actual business itself, not so much the products. And so I've had this was it was basically it turned into a partnership business. So it wasn't just me in the business. I had a couple of partners. And these partners, they were more or less silent partners. They were investors, yeah, and they really helped me in terms of financing the operation. So that's why I like this chapter because it means it's I can relate to it. But also, I think that when you have your businesses or um, you start working in a business where there's partners involved, it's good to understand how those partnerships are formed, how they work, and of course, how the accounting side of things works as well. So that's why I like this chapter. So tonight, we're going to talk about the different types of businesses that exist, the characteristics of them, especially for partnerships. We're going to talk about how they're formed, the transactions that are involved as they're formed, the journal entries. We'll talk about how we account for the admission of a partner, what happens with allocations of like distributions to partners, what happens when the partnership is dissolved or a partner withdrawals from the business. So, really, really good conversation tonight. I'm looking forward to this one. So, first, I'd like to talk about the partnership business and what's all involved in a partnership business with respect to its organization. So, partnership formation. When we create a partnership, it's a business between two or more individuals, right? Two or more individuals makes a partnership. We consider these people co-owners of the business. Many businesses are organized as partnerships. It's very common, especially in like retail businesses like the one that I had, and also service businesses. In fact, I had a student last semester. He has a maintenance business where it's kind of real estate focused, and so he has service agreements for taking care of the maintenance for apartment buildings in DC. Really cool business. I got a chance to talk to him a lot about it, and he has a couple of partners that works with him. So I talked to him at length about partnership accounting last semester when he took this class with me. So a lot of professionals, including physicians, lawyers, accountants, a lot of those types of practices, they organize partnerships. It's typically a partnership type of business. These partnerships are voluntary in nature, so there's no requirement to be in a partnership. It's strictly voluntary. So, but to, of course, form a partnership takes two or more individuals that are willing to agree to terms. So we call this a partnership agreement. And in that agreement that is in writing or expressed verbally, It includes things like the partners' names, what they've contributed to the business or will contribute to the business, whether it's cash or equipment or property or whatever, right? Bringing what are they bringing into the business, or if they're bringing in loans or other liabilities. It also identifies the rights and responsibilities of the partners. If the partners are sharing equally or based off of their investment, sharing in the income and losses. The agreement also discusses withdrawal arrangements. Should one partner leave the business, what happens? There's a dispute process and procedure. When partners disagree. There's rules for admitting and withdrawal of partners and rights and responsibilities in the event that a partner passes away in the course of business. So all of those types of things are identified in what we call a partnership agreement. When it comes to taxation, the partnership itself does not pay income tax. The income tax gets passed along to the individual partners and are a part of their regular individual tax returns. So if you're a part in a partnership agreement, when the business gets taxed on their sales, that sales tax gets passed through the business. Okay? It falls on the responsibility of the partners to make sure that the sales tax is paid. All right? And any net income that the partnership earns, or operating income that the partnership earns, each individual partner has to pay tax on that. Okay? It becomes a part of their regular tax return, the individual tax returns. So that's how partnerships are treated when it comes to tax. The other thing you need to know is the uh, life of a partnership. It's limited. Okay? A partnership does not live forever because one of the partners will die. One of the partners will go bankrupt. Something will happen that will end the partnership. And when the partnership ends, we call that being dissolved. So partnerships have a limited lifespan. Partnerships also have what we call mutual agency. This is where each partner in the business can bind the partnership to contracts. This could be kind of risky, okay? So let's say Anastasia and I decide to form a partnership business, all right? And we just so happen to be selling, I don't know, some type of retail products. And Anastasia and I, we're pretty good friends. We work pretty well together. But sometimes we don't always see eye to eye. So I might decide to go and take a loan out for the business without telling her. All right. She might get a little upset with me. I get it. Yeah, it's okay. You could be upset with me. It's fine. But let's say I decide to take a loan out for the business without telling her. Well, first of all, that's bad on me because I should always be talking to my partner and everything that I do, right? But I go take a loan out without telling her. It automatically signs her up for that loan, right? Because she's one of my partners in the business. So Anastasia and I were both required to take care of that loan, even though I was the one that signed up for the loan without telling her. We call that mutual agency, right? So it could be a good thing, but it could also be a bad thing. And then partnerships also have unlimited liability, which also not great. What that means is that in the event that the partners can't pay the debts of the business, the creditors can go after the partner's personal assets. So let's say Anastasia and I are partners. right? The and we can't pay the debts of the business. What'll happen is the bank will come after my house. They'll come after my car. They'll come after my personal bank account. That's unlimited liability. Yeah. So that's one of the drawbacks. So it's also important to make sure that whoever you go into business with, make sure that they can take care of any type of debts. The business is a co-ownership of the property, which means that the partnership assets are jointly owned by all the partners. So, for example, if I bring a piece of machinery into the business, both Anastasia and I own that machinery, right? Because all the partners jointly own all of the assets in the business. So, those are the types of things that make a partnership. Now, the cool thing with partnerships, and this is good to know, is that we can find a way to limit our liability depending on how we form the partnership. We can have what's called a general partnership where there's unlimited liability. Not that great for either of us because, I don't want the bank coming after my house. So we might go with a limited partnership. We both have management responsibilities and liabilities for the debts, but we don't have any limited liability past our invested amount in the business, which is nice. That means the bank cannot come after my house, right? We also have a limited liability partnership, which protects innocent partners from malpractice in case, let's say, Dr. B does something stupid and the company gets sued. Anastasia will be safe, and you know, the business will also be safe. So we call that a limited liability partnership. The partnership could also become what we call an S corporation, which is very common when there's a lot of partners involved, like 100 or less. This S corporation gets treated where the individual owners have limited liability and pass through when it comes for tax purposes. So the partnership, the owners of this S corporation treat the partnership for income tax purposes. Yeah. So that part's kind of nice. And then lastly, the company could become what we call an LLC, limited liability company. So very similar to limited partnership. The primary difference here is for tax purposes. With an LLC, the business itself doesn't pay the tax, but the partners have limited tax. Yep. So LLC is probably the most common one, I think, that a lot of businesses select. But these are the types of partnerships that can be created. So once we decide which one to select, we then go through the process of forming the business. So will create the formal partnership agreement. We'll discuss who owns what, who brought in what into the business, what the percentages of ownership are. All of those things are discussed at the point where we set the business up. So, when we select the type of partnership that it is, we want to do the one that's most advantage for us to limit our taxation and also to limit our liability. So I think that's one of the reasons why LLCs are so popular. Um, there's limited liability, and the individual's partners have to pay the tax. But that's also why corporations are popular as well, because there's limited liability, and the business itself has to pay its own tax. So it really depends. It depends in what the partners agree on and what they're most comfortable with. So let's talk about how we account for the formation of the partnership. The partnership really depends on what the individual partners are bringing in. So Anastasia and I were partners in this business, and we both can bring in assets into the business. So we can contribute cash to the business. We can contribute equipment to the business. We can contribute buildings, land, whatever, right? And we can also bring in loans into the business. So each partner can bring assets and liabilities into the business. The assets and the liabilities are recorded at their market value when they're brought into the business, and we identify these as contributions to the business. So when we set it up, we'll debit the asset account and we're going to credit the equity account for that owner. We call that paid in capital. Okay. If it's a liability, we're going to debit the owner's paid in capital account and we're going to credit the liability. So, right, those are the types of entries that we make, and it helps us to record the market value of the liabilities and equity. I'm sorry, the assets and liabilities that we bring into the business. The asset contributions obviously increase the partner's account, and the liabilities decrease the partner's account. After the first year of operation, the owners allocate the net income or net loss based off of the partnership agreement. So Anastasia and I are partners in this business. We own the business 50%, 50%, which means that we share equally in the net income or net loss. Okay. That net income or loss gets distributed to the partners based off of their percentage of ownership. So for 50-50, let's say we have $100,000 in net income, we each get 50,000 allocated to our partnership accounts. So at the end of the month, we allocate the net income to retained earnings. That retained earnings gets distributed to each partner. Yeah, that's how that works. So when we form the partnership, there's a couple of steps that we need to go through. And there's a couple of things that need to be correct as we form this partnership. So the first thing is that the partners can take the money out of the business, basically. And so each partner has the right to take the assets and liabilities out of the business. And the way that they do that is they debit an account called owner's withdrawals. And then they credit the cash if they're taking out cash. Yep. The second thing that partners have the right to do is to uh, take out what they've earned through net income. So in that case, they would debit the I'm sorry, yeah, I'm sorry. They would debit their their share and they would credit the net income. Um, the partners also have the ability to take out anything out of their capital account, or they have the also ability to withdraw from the partnership. And so that's why we keep all of the partner accounts separate. We list them as paid in capital accounts, and they're based off of the partners' names. So that's how that works. But these three things must be true in order to form a partnership. So I'm going to walk you through an example with three partners, but the business started with two. So here I have two partners, Kayla and Hector, and they decided to form a partnership where they offered facilities for skateboarding and snowboarding. That's cool. Yeah, it sounds like a fun business. Okay, so Kayla, she invested $30,000 into the business. And let me explain how it's 30,000. So she decided to contribute $7,000 in cash. She also decided to contribute $33,000 in a building. Okay, great. So that would be 40,000 that she's contributed to the business. However, she also brought in a note payable. So, because she brought in $40,000 in assets, she also brought in a $10,000 note. That means that her paid in capital account is $30,000. Make sense? So, in other words, 40,000 in assets, 10,000 in liabilities. According to the accounting equation, 40,000 in assets equals 10,000 in liabilities. The difference is equity, in this case, 30,000. And her equity in the business is $30,000. So we debit cash, debit the building, credit the note payable, and credit her paid in capital account. That's how that works. That records Kayla's investment into the business. Then we have a second partner. His name is Hector, and Hector decided to simply contribute $10,000 in cash to the business. Great, easy transaction there. We just debit cash, and we credit paid in capital for Hector, 10,000. So what that did is those are our entries to start the business, basically. So then some time goes by. Let's say the first month goes by. It's time that we recognize income or loss. And the income or loss gets distributed to the owners. Now it's based off of the partnership agreement, but there's a couple of ways that this can be done. So I'm going to talk to you about three different ways that this can work. So based on the partnership agreement, they can decide to distribute net income or loss in three ways. The first is based off of what we call the stated ratios. Real simple. It just identifies the percentage ownership in the business for each owner. For example, Caleb, she brought in $40,000 into the business. Hector brought in 10,000. So if you wanted to look at it from a ratio basis, we could say that, based out of that 50,000, 40 out of 50 belongs to Kayla. We can say that that's 2/3 of the business, or 0.66, right? 0.66 or 2/3 of the business belongs to Kayla. Hector brought in $10,000 in cash. We can say that 1/3 of the business belongs to Hector, or 0.33. So therefore, it equals 100%, right? So 2/3 of the business belongs to Kayla, 1/3 of the business belongs to Hector. We call that stated ratios. So based off the partnership agreement, if it's based off of stated ratios, for everything the business earns in net income, we multiply that by the stated ratio. Or net loss, we multiply that by the stated ratio. So that's option one. Option two, the partnership agreement could say it's based off of the capital balances. So the capital balances can also be expressed kind of as a percentage if you think about it. But it's a ratio of the capital balances. So Kayla brought in 40,000. Hector brought in 10,000. That's a total of 50. 40,000 divided by 50,000, that gets us a ratio. 10,000 out of 50,000, that gets us a ratio. And those ratios can be utilized and carried forward for all net income and loss. So we take the net income or loss amount and multiply that by the stated ratio. I'm sorry, the ratio of the capital balances. And the third option that could be expressed in the partnership agreement is that the partnerships could take a salary and interest allowances if there's any, and any remainder based off of a fixed ratio. That's an option. Sure. Yeah, we can pay salaries and interest out, but here's the thing. If it's a loss, they still collect their salaries and interest, but the business, they end up losing out of their equity account. So I'll show you what that looks like soon. But one of these three options they'll select, and it'll be stated in the partnership agreement, and they'll move forward to distribute net income or loss based off of one of these three. So let's take a look at the stated ratio option. So with the stated ratio method, we allocate the partnership income or loss based off of this fraction. It's a stated ratio, right? So Kayla has a fraction of 2/3, so she owns 2/3 of the business. All right. She owns 2/3 of the business. So we take the net income amount, in this case 60,000, or if it was a loss, we would take that amount. We multiply that by her stated ratio. In this case, it's 2/3 or 0.33. And so, I'm sorry, I'm sorry, 0.66 or 2/3 times the 60,000, that's 40,000. All right. So out of the 60,000, 40,000 is going to go to Kayla based off of the stated ratio, and the remainder goes to Hector, 20,000. So we debit income summary, which is how we close out our temporary account, and we credit Kayla's paid in capital for 40,000, and we credit Hector's for 20,000. Again, we take the net income amount, we multiply that by the stated ratio, 2/3 and 1/3 respectively, or 0.66 and 0.33 respectively. So that's based off of the stated ratios. Another way to do it, as I had mentioned earlier, is based off of their balances. This is the second method. So based off of their balances, we can distribute the net income. Kayla brought in 30,000. Hector brought in 10,000. These are their balances, right? So the total is 40. We would take the 30,000 divided by 40,000. Guess what? That's 75% or 0.75. And for Hector, 10,000 out of 40,000. Guess what? That's 25%, right? So we take the net income times the percentage. So 60,000 times 75%. We're going to allocate 45,000 to Kayla. 60,000 times 25%. is 15,000 that gets allocated to Hector. Okay. That's how we allocate based off of their capital balances. Pretty straightforward, pretty easy to do. Now the next one, the third option. Sometimes the most complicated one, depends how you look at it. The allocation based off of service, capital, and stated ratios. So, as I mentioned before, the third option is where the owners or partners of the company can take a salary plus interest. Now, here's the thing with that. If it's net income, that's great. You know, that's a positive thing. If it's a net loss, they still collect their salaries and interest, but it might put their accounts into the negative. So, got to be careful there, right? So here we go with our example. According to the partnership agreement, uh, Kayla will receive $36,000 annual salary, and Hector will receive $24,000 annual salary. Each partner is allowed an annual interest of 10% based off of their beginning capital balances. If there's any remaining net income or loss, it's allocated equally, meaning we split it in half. So let's say that we have a net income of 70,000. Well, that would be pretty good because 70,000 covers both the salaries as well as the interest. And there's some positive left over. Nice. Okay, so let's say net income is 70,000. 36,000 salary to Kayla. 24,000 salary to Hector. Okay, great. Then we have 10% interest based on their capital balances. Kayla has 30,000. Hector has 10. So 3,000 and 1,000 respectively. That brings Kayla to 39,000 and Hector to 25,000 for a total of 64. We take the 70,000 net income minus the 64,000 that's paid out in salaries and interest, giving us a remaining balance of 6,000. According to the partnership agreement, the 6,000 gets allocated equally. Okay? So that's 3,000 apiece, which brings Kayla's capital balance to 42,000 and Hector's capital balance to 28,000. So it's great when it's a, positive amount. But what happens when it's a loss or the net income isn't high enough to support the salaries and interest? Which definitely happens, right? So let's say instead of 70,000, they only made 50,000. Uh-oh, that's a problem. So let's take a look. Instead of 70,000, they only made 50,000. Ooh, okay. So we still pay out their salaries, we still pay out their interest. 39 and 25 respectively, that's 64,000. 50 minus 64,000 is a negative 14 grand. According to the partnership agreement, they split the profit and loss equally, whatever's left over, right? So, minus 14,000 gets distributed equally, minus 7,000 each from their capital accounts. This brings Kayla down to 32,000 and it brings Hector down to 18,000. Whoops. But that's what happens, right? That's based off the partnership agreement. So again, if you get into a partnership with anyone, just make sure that each partner has enough to cover. So, uh, throughout the year, we can see uh, these allocations. Uh, what am I going to show you here? I'm going to show you. Okay. Partnership statements look like this. This is called a partner's equity, also known as a statement of partner's capital. Okay. This is a very common financial statement when there's a couple of partners in a partnership style business. Yeah. And all this does is it shows their capital investments, the net income, how it's distributed, if they have salaries, interest, anything like that. It all shows up on this type of statement. So just want to kind of show you what this statement of partners' capital looks like. Now, as time goes on, sometimes other people might get interested in your business. They might be like, hey, I see Anastasia and Dr. B out there, and they're doing pretty good with their business. I'm kind of interested, and I wouldn't mind joining their business. That's great. We call that an admission of a partner. So I'm going to talk about this. The partnership is based off of individuals within the partnership. If there's a new partner that wants to be admitted, or if there's a partner that wants to withdraw from the business, the present partnership will end and a new contract, or I should say, a new partnership agreement gets created. Okay. So, and that new partnership will involve the existing partners plus whoever is coming in or if somebody's leaving. So here we have new partnership. Uh, we have somebody who's interested in joining Anastasia and myself. And so with this new partner, we are going to allow them into our business in one of two ways. Either the new partner purchases existing ownership from one or both of us, or the new partner can invest assets into the business like cash or other assets like equipment or land. So those are the two ways that a new partner can be admitted into the partnership agreement. So let's say um, that a partner wants to purchase interest in the business by purchasing it from one or both of the existing partners, which is totally fine. So that cash goes directly to the partners, not to the partnership itself. Right. So if somebody wanted to join Anastasia and me in a partnership agreement, then that third person can purchase uh, admittance to the business directly from Anastasia or myself or both of us. So that's one way of admitting a new partner. We call that buying interest into the business. So let's look at it from our example. We got Kayla, we got Hector, and now we have a new partner, Terrell. Okay. So Terrell wants into the business. Terrell decided, hey, I'd like to buy into your business. And so the way that Terrell wants to do that is by uh, purchasing interest in the business directly from Hector. Okay, no problem. So uh, the way it works is that Terrell is going to give cash directly to Hector for the amount of $13,000. That 13,000 does not go into the business. All right. Uh, oh, I'm sorry. I think it's $18,000 was the original investment. Yep. So $18,000 uh, purchasing into the business. 13,000 of that going directly to Hector. Or I'm sorry, it all goes to Hector, but Hector's only going to give Terrell $13,000 interest. Okay. So so in this we debit Hector's account to reduce Hector's account, and we credit Terrell's account to establish Terrell's account. All right. So that's one option. Another option is that a new partner can invest assets like cash or equipment or a building or whatever into the partnership to gain admittance. And so in this, it's a real simple. All that's happening here is that the new partner is contributing the asset to the business, and that amount of assets will help to allocate the amount of ownership in the business. So in this case, Terrell has decided very simply to contribute $22,000 in cash into the business. Great. So we debit cash 22,000 and we credit Terrell's account 22,000. And that shows Terrell's admittance into the business. Real simple. However, this does not mean that Terrell automatically receives 22% ownership in the business. It's based on the partnership agreement. And that partnership agreement can specify the ownership in three different ways, as you know. One could be based off of the stated ratio. The other could be based off of their capital balances. Uh, and then there's the third way. So it depends. It depends on the new partnership agreement. Another thing that could happen is that when a new partner wants admittance to the business, they could pay bonuses to the existing partners. Sure, yeah, that's totally fine. I've seen that type of thing happen before. It's a way of saying thank you to the existing partners, if you will. So that's one possibility. Another possibility is that the existing partners could pay a bonus to the new partner. Now, this commonly happens when the new partner is bringing in a particular skill set that the business needs in order to grow. And so that would be why a new partner might receive a type of bonus, if you will. So I'm going to show you what it looks like when a bonus is paid to the existing partners and when a bonus is paid to the new partner. So here we have an example where a bonus is being paid to the new partner, or I'm sorry, to the existing partners. So here's how it works. January 4, Kayla and Hector agree to accept Terrell as a new partner in the business based off of his investment of $42,000 cash into the partnership. Terrell will receive 25% ownership in the business. Any bonus is attributable to the existing partners and is shared equally. All right. So the existing equity owned by Kayla and Hector is 78,000. Terrell's investment is 42,000. That would bring the total partnership equity up to 120,000. We multiply that amount by Terrell's percent ownership, which is 25,000. which means that Terrell's equity balance will be 30,000. 120 by multiplied by 25%. So once we know what Terrell's capital balance will be, we can then figure out how much bonus will be paid to both Kayla and Hector. So it said, Terrell's bringing 42,000 in cash into the business. We just figured out that 30,000 of that is going to be allocated to Terrell's equity balance. Okay, makes perfect sense. The remainder, $12,000, will be distributed to both Kayla and Hector equally. Right? So we debit cash 42,000. We credit Terrell's capital account 30,000. The remainder gets split between Kayla and Hector evenly. So that's 12,000 divided by 2. Get you 6. So it'll be 6,000 for each. We credit Kayla 6,000. We credit Hector 6,000. So that's how it works if a bonus is paid to the existing partners. Now, in some cases, the new partner might receive a bonus. That's because maybe they're bringing in exceptional skills to the business. Very talented individual, Terrell is. So Kayla and Hector decide, hey, you know what? We'll accept Terrell based off of his investment of $18,000 in cash. We're going to give Terrell 25% ownership into the business, and we're going to attribute any bonuses we decide to pay directly to Terrell based off of his skills. So cool. That's a nice partnership agreement. So Kayla and Hector have $78,000 in equity combined, plus Terrell's investment of 18,000. That brings the total partnership equity to 96,000. We multiply that by the 25% ownership that Terrell will have. That gives Terrell an equity balance of 24,000. So now that we know that Terrell will have an equity balance of 24,000, we can figure out how much of the bonus that both Kayla and Hector will allocate to Hector. I'm sorry, to Terrell. Kayla and Hector will allocate to Terrell. So, using that same information, Terrell's contributing 18,000 in cash. We know that his capital balance is going to be 24,000 based off 25% ownership. And the difference between the two is 6,000. So we take the 6,000 divided by 2 is 3,000 each. So we debit cash 18,000. We debit Kayla's and Hector's account by 3,000 each. That 3,000 each gets allocated to Terrell's account, which brings Terrell's account up to 24,000. That's how that works. That formula on this slide is kind of ridiculous. I don't know. They make things more complicated than it needs to be, honestly. This textbook does. So I just take 6,000 divided by 2. Makes it a little easier. All right. Now, in some cases, one of the partners will withdraw from the business for whatever reason. They want to get out of the business. There's a disagreement. There's some type of whatever's goes on. So the partner decides to leave. It happens. Yeah. So there's really two ways that this can happen, where the partner decides to leave the business. One is that that leaving partner can decide to sell their interest to a third party, or they can distribute it to the existing owners. Uh, Very common, very typical. Or the partnership can distribute cash or other assets to the partner that's leaving. They can be paid out. That's also common. And sometimes it can be paid out with a bonus or without a bonus. It depends on the partnership agreement and what the existing partners agree to. So here we have an example where one of the partners, Hector, has decided to leave the partnership. And Hector is going to leave without a bonus. Okay. So no problem. This happens. So it's a really simple concept. All we do here is we debit Hector's account for the balance, in this case 38,000, and we credit cash 38,000. He's just taking out what his balance is. Easy peasy, right? But it's not always as straightforward as it looks, because sometimes a bonus could be paid to the existing partners or to the partner that's leaving. So let me show you an example where a bonus is paid to the remaining partners. So very, very common as well. And these bonuses um, are considered a one-time bonus, and it depends, like once again, on the partnership agreement. So in this case, Hector's capital balance was 38,000. They've decided that Hector will receive 34,000 upon withdrawal from the partnership. The remainder, $4,000, will be given to the existing partners according to the income and loss sharing ratio, which in this case is 50%. So each remaining partner will receive $2,000 to their capital accounts as a form of bonus. So we debit Hector's paid in capital account. We credit the cash 34,000. The remainder 4,000 distributed equally based off of the income and loss sharing ratio to the remaining partners. So 2,000, 2,000 respectively. Now, once in a great while, the partner that's leaving can receive a bonus. That's cool. And that bonus comes out of the remaining partners. So just as before, Hector had a capital balance 38,000. The partners have agreed one-time payment of a bonus of $1,000 each. Now, here's the thing. That $1,000 each comes out of the existing partner accounts, or I'm sorry, remaining partner accounts. And then $40,000 is paid directly to Hector. Yeah. So nice. It's a nice thing to get paid a bonus when you leave a company. Now, sometimes life goes on, and one of the partners might die. Right? It happens. It's life. So when a partner dies, it dissolves the partnership, obviously, right? Um, the estate of the partner that is deceased could inherit, so to speak, uh, that part of the business that partner owned. So oftentimes, what will happen is that the partnership will distribute anything that partner who's deceased had to the estate of that person is deceased. So what happens is that there's a closing of the partnership books of the income and loss to determine the end of the prior accounting period and determine what gets recorded at market value for assets and liabilities. and then there's a settlement involved. Yeah. So, yeah, life happens, right? So it's one of those things. So when something like that happens, or if the partnership decides to dissolve, the partners agree, hey, listen, this isn't working out. Let's close down the business. No problem. There's three steps that are required to dissolve the business. The first step is to identify a gain or loss on the liquidation of the assets that the partners have based off of the income and loss agreement. The second step is to pay any remaining liabilities that the business has, or also known as partner liabilities. And the third step is to distribute any remaining cash to the partners based off of their capital balances. That's the three-step process for dissolving a business that's a partnership. So I'm going to walk you through if there's a deficiency of one of the partners, meaning they don't have enough to cover, or if there's not a deficiency, or what happens when there's liabilities that remain. So the first is no deficiency. This means that all the partners have zero credit balance in their capital accounts. They have enough cash to cover any liabilities, and whatever is remaining gets distributed based off of their capital balances. So here we have Hector, Kayla, and Terrell. They agree to dissolve the partnership. There's only one outstanding bill of $20,000 sitting in accounts payable. So they decide to dissolve the partnership. The balance sheet looks like this. They have 178,000 in cash, 40,000 in land, account payable 20,000, Kayla's capital account 70, Hector's capital account 66, and Terrell's capital account 62. So the first thing that we're going to do is we're going to liquidate the assets, and so that includes selling the piece of land. So January 15, we decided to sell the land for 46,000. The land was brought into the business at a cost of 40,000. The difference is six. So that's a gain on the sale of the asset, $6,000. So we debit cash 46,000, credit land 40,000, and credit the gain on the sale of an asset, 6,000. Also on that day, uh, that 6,000, the gain on the sale of the asset, gets distributed to the owners, to the partners, equally based off the partnership agreement. So each partner is going to receive $2,000 to their paid in capital accounts. So we debit the gain on the sale of the asset, and we credit each partner account $2,000. So all of that to sell and dissolve the land. The second step is we got to pay the bill. There's a $20,000 account payable. So we're going to debit the account payable and credit cash. So of course, that's obviously coming directly out of our cash account. The remaining cash is going to be distributed to the owners based off of the partnership agreement, and that's based off of their capital account balances. Okay. So based off of their capital account balances, we distribute the cash accordingly. Here, Kayla has 72,000, Hector's got 68, Terrell's got 64. The cash account had $204,000 balance, even after the payment of the liability. So nice and easy. The remaining cash gets distributed to the owners, and the business is now dissolved. Sometimes it's not always that easy, and one of the partners might not have enough in their capital account to cover, meaning that they have a credit balance in their capital account. Whoops, that's not so good. It means that maybe they took too many distributions, too many withdrawals, whatever the case might be. So the remaining partners need to cover the difference. So I'm going to show you what that looks like. So once again, we have Kayla, Hector, and Terrell agree to resolve the partnership. In this case, the balances were this. We had Kayla had a capital balance of 19,000, Hector had a capital balance of 8,000, and poor Terrell, he must have overdrew his account, has a negative $3,000 in his capital account. So what this means is that the existing partners need to be able to cover Terrell's negative 3,000 bucks. All right. So one option is that Hector can pay the business $3,000 to cover his negative balance to get him up to zero. So decides to do that, debit cash 3,000, credit Terrell's account 3,000. That covers Terrell's deficiency in his account. The remaining partners will receive their capital balances. So Kayla had 19, Hector had 8. So the cash distributed is 27 to close out the partners' accounts. That's one option. Assuming that Terrell can pay the 3,000. Now, what happens if Terrell cannot pay the $3,000 to get his account back up to zero? Well, that means that the existing partners need to cover the difference. So, according to the partnership agreement, it's 50-50. So, meaning that all of the partners pay equally. So, both Kayla and Hector will cover Terrell's deficiency by contributing the $3,000 equally to Terrell's account to get it up to zero. So, we debit Kayla and Hector's accounts by 1,500 each. Got it up to zero. Now, after that, we can distribute the remaining cash to Kayla and Hector equally, based off their account balances. So Kayla would receive 17,005, and Hector would receive 6,500. And that's how we dissolve a partnership. In all of those eventualities or possibilities. Now, one ratio that I like to talk about is called the partner return on equity. I like this ratio because it really shows us how each partner in the business is uh, their assets they brought into the business are being utilized. Yeah, return on equity. So let's take a look at this. So this type of ratio, real easy to calculate. We take the partner's net income and we divide by average partner equity. Now remember, in accounting, anytime you hear that word average, it's the beginning balance plus the ending balance divided by 2. So we call that ratio partner's return on equity. And that, my friends, brings us to the close of this discussion on partnership accounting. So just to remind you as to what's due, when it's due, what's going on in the classroom. So for this week, by Sunday night, you have 2 action items to complete. The first, under the Engage and Explore section of this week, you have the Financial Accounting Part 2 LinkedIn Learning Certificate to submit. And then under the Action and Expression, you have the Chapter 12 quiz to complete. So 2 action items, LinkedIn Learning Certificate 1, 2, Chapter 12 quiz. Both of those are due by this Sunday night. Are there any comments, questions, or concerns that you have that I can help to address at this time?
Yeah, Professor, I got a question.
Yeah, please.
Where can we find like the LinkedIn accounting financial
You're talking about this.
part two?
I'm sorry, for which one?
For the part two, the financial accounting.
Yep. Great. So, just like you've done before for the previous ones, you're going to go to this
Yeah.
week, which is week 12. You'll open up the folder that says Engage and Explore,
Yeah.
and then you're going to select directly right here. It says Financial Accounting Part 2. It'll open up, and just like you've done before, you're going to watch all of the videos, download the certificate as a PDF at the very end, and then you'll upload that right below it where it says Financial Accounting Part 2 certificate.
Okay. Thank you. Because I was about to do it last week, but I
Sure.
couldn't find it.
Oh, no problem. Yeah, that's because it's under week 12 instead of week 11.
Okay.
Okay. Great. Thank you for the question. I appreciate that.
No problem.
And then, of course, the second thing that we need to complete this week is the Chapter 12 quiz. Are there any other comments, questions, or concerns? Anything at all?
Thank you, Professor. It was nice to have a business with you.
Always a pleasure, Anastasia. We know it's a good partnership, I think, and hopefully it'll be successful.
One question: what kind of business did we have?
It's up to you. It's whatever we decide to do.
All right, sounds good.
Oh, great. Okay. And also just looking forward, we're really close to the end of the semester. So next week we're going to do accounting for corporations. Week after we'll do long-term liabilities. That's also Thanksgiving week, so that'll obviously be done on the Tuesday before. Week 15, we're going to have investments and statement of cash flows together. They're both very short chapters, so we'll be able to get through that no problem. And they'll be done on December the 4th. And then we'll have the final exam, which will take place on 12, December the 11th. And that'll bring us to the end. So thank you all so very much for your time. I really do appreciate all of you and all of your efforts. If you ever need anything, please feel free to reach out to me. I'm here for you. So I want you to do well and to continue making great progress. So again, if you need any help, just reach out to me, okay? I'm here for you. Thank you all so much for your time. Appreciate all of you. Have an awesome night. And I'll see you all again. Actually, I think the next time we meet will be next Thursday again, right? Which will be where are we? We're 13 now, which will be the 20th of November. So see you all again next Thursday. Thank you so much. Appreciate all of you. Have a great night.
Thank you, good night, Professor.
My pleasure. Take care. Catch you later. Bye-bye. Good night. Good night. Ciao for now.